In this video, we'll learn about the different types of orders. Let's take a closer look at what we will cover. We'll start by looking at the different types of entry orders. We'll then look at the different types of exit orders. And finally, we'll take a look at a couple example trades. Let's start with the different types of entry orders. There are a few different ways to get into and out of trades. These are entry orders and exit orders. Let's look at the different kinds of entry orders. We have market orders. These are orders that are carried out by the way. We also have pending orders. These orders are set in advance before price reaches a certain level. To exit trades, we have different types of exit orders. The close trade order will exit the trade immediately. The stop loss order is always placed behind the price. And the take profit order is always placed ahead of the price. We'll take a closer look at each of these in more detail as we move on. Now let's take a look at the different kinds of entry orders. As I mentioned, there are different types of entry orders. You have market orders, which you can use to buy and sell, and you have pending orders, which are placed in advance. Under pending orders, you have stop orders and you have limit orders. And for both of these, you have the ability to buy and sell. Let's start with market orders. Market orders allow you to enter a trade instantly at the current market price. So if you want to get into a trade right now, you'll use the market order. You may choose a buy market order or a sell market order. Entering a market order is usually as simple as clicking buy or sell on your trading platform. Once you click buy or sell, you're taken to a confirmation screen, click the OK button, and you're taken into the trade. Now let's take a look at pending orders. Remember, a pending order is an order that you place on your platform that is not entered instantly like a market order. Stop orders is the type of pending order. A stop order is placed ahead of the current market price. We'll take a look at a buy stop order. A buy stop order is an order to enter a buy trade. You will use a buy stop order when the market has not yet reached the price you want to enter the trade. Let's take a look at an example of a buy stop order. For a buy stop order, price will start off being underneath the buy stop order, and it will have to rise to meet the entry level and to take you into the trade. As you can see in the image here, the solid white arrow is moving below the red horizontal dashed line. That red horizontal dashed line is our buy stop order. In order for us to be taken into the trade, price will need to rise and hit this level. As soon as price reaches the red horizontal line, we will be taken into the trade, and in order for us to make a profit, the price will need to continue moving upwards. So with our buy stop order, we will place the order above the price that we want to enter. Price will then need to move upwards and reach our buy stop order level. As soon as it reaches this level, we are taken into the trade, and in order to take a profit on this trade, price will need to continue moving upwards or get higher. Let's look at a sell stop order. A sell stop order is used when the entry is below the current market value or the current market price. Price will have to drop from where it is to your desired entry level. If you are entered into a sell stop order trade, you want the market to continue moving lower in order to make a profit. Let's take a closer look at an example. Here you can see a sell stop order. Price starts off being above the sell stop order and will have to decline to meet our entry price. As you can see, I have a solid white arrow that shows the current price. The red dashed horizontal line shows our sell stop order. In order for the sell stop order to be triggered, price needs to fall and reach this level. As you can see, price falls from above the sell stop order, then touches the sell stop order, and in order for us to make a profit, price will need to continue falling. Now let's talk about limit orders. Limit orders are also pending orders, but they're slightly different. A limit order is a pending order, but it is used when you want the market to hit a certain price and then change direction. This is used frequently in a range-bound market, that is, a market that is bouncing up and down within a defined high and low range. A buy limit order is used to get into a buy trade. Let's take a closer look at an example. Here you can see a buy limit order. The market has to initially be moving downwards. It would then hit your entry price, and then to make a profit, price must move back upwards. You always enter a buy limit order from above. As you can see on the image on the chart, I've got the white solid arrow, which represents the current price. Price is moving downwards, and when it encounters our red dashed horizontal line, which represents our buy limit order, we're expecting price to reverse and continue moving upwards. So in order for us to make a profit on this trade, price will need to fall, hit our buy limit order, and then move upwards. Now let's take a look at a sell limit order. A sell limit order will have you taking a sell trade, but the market has to approach your entry level from below. You always enter a sell limit order from below. Take a look at the image on the screen. As you can see, I have the solid white arrow, which represents the current price. We also have the red dashed horizontal line, which represents our sell limit order. As you can see, the current price has started below the sell limit order. It then rises upwards, touches the sell limit order. At this point, we are taken into the trade. In order for us to make a profit on this trade, price needs to reverse. It needs to stop moving upwards and start moving downwards. And if this happens, we'll make a profit using the sell limit order. Now let's take a look at exiting orders. Exiting a trade is just as important as entering into one. We'll start by looking at the closed trade order. Like a market order, for instantly getting into a position, you can simply close the trade or exit the trade to get out of the position. Closing a trade is something you have to be present for, and you would do this manually. You can close a trade in profit or at loss. You're not restricted to closing a trade only when you're in loss or only when you're in profit. You could close it at any time you want. To get out of a trade at a specific price, no matter if you are there watching the trade or not, you can use a stop loss or take profit orders instead. The stop loss order allows you to set the maximum loss a trade can have before closing the trade. The take profit order allows you to set the profit you want to earn before closing the trade. For both the stop loss and the take profit, you will manually enter in the price that you wish to be taken out of the trade. Because the market ranges and moves up and down, the take profit allows you to exit the trade in a profit before the market moves in the opposite direction. Let's take a closer look at the stop loss order. The stop loss is an order that will always be behind the market price. If you are buying, your stop loss will be under the current price. And if you are selling, the stop loss will be above the current price. Stop losses can be used in two different ways. The first way is the initial stop loss, and then you have the trailing stop loss. For the initial stop loss, you will normally place this order when you've entered the trade. This is the maximum number of pips or maximum amount of money that you're willing to lose on this particular trade. This level is fixed and does not change. The trailing stop, on the other hand, will move closer towards the market price as the price moves in your favor. For example, if you're in a sell trade and price continued to fall lower, the trailing stop will move your stop loss closer to your entry level. At a certain point, when prices moved far enough, your stop loss will be at break even. That is when it is equal to the entry level. At that point, if the market reverses and goes on to hit your stop loss, you will lose nothing and you will gain nothing. If price continues to move further downwards and in your favor, your trailing stop will exceed the entry level. And if price reverses, you'll be taken out at a profit. So that's how the trailing stop works. Now let's take a closer look at the take profit order. Take profit orders will be placed in front of or ahead of the market price. If you are in a buy trade, your take profit will be higher than the current price. And if you are in a sell trade, the take profit order will be placed below the current price. A take profit order can be considered as a target. This order will close your trade once your target has been reached. Now let's take a look at a couple of example trades. This will help you get a better idea of how to apply your stop losses, take profit levels to your entries. In the first example, we're looking at a buy trade. As you can see, the solid white arrow represents the price. I've inserted a blue horizontal line that shows the entry level. The red horizontal line shows our stop loss, and the green horizontal line shows our take profit level. As you can see in this particular example, we're in a buy trade. We entered the buy trade when price crossed over the blue line. At that point, we decide to place our stop loss below the price. Because we're in a buy trade, our stop loss will always be below the price. Now, if price were to turn around and reverse and start moving downwards and hit our stop loss, we would be taken out of the trade at a loss. But if price goes the way we think it will, and if it continues to rise, and it goes on to tag the take profit level, the green line, we will be taken out of the trade immediately with a profit. Now let's take a look at an example of a sell trade. Here you can see on the chart, I've inserted a blue horizontal line that shows the entry level. The take profit level is shown by the green horizontal line, and the red horizontal line represents the stop loss. The white arrow represents the current price. As you can see, this is a sell trade, so price approached our entry level from above. We were taken into the trade at the blue line, and if price had reversed and started moving upwards, we would be exited from this position as soon as it touches the red stop loss. Of course, we'd exit this trade with a loss. But if price continues to fall and continues to keep moving lower, and then goes on to reach our take profit level, the order will be closed and we will exit it with a profit. Well, that's it for this video. Thank you for watching, and I'll see you in the next one.